Most taxpayers guess their quarterly taxes and guess wrong. That's why so many people end up overpaying the IRS during the year, or worse, getting hit with underpayment penalties. But here's what most people never learn. The IRS has built-in safe harbor rules that can help you avoid underpayment penalties even if you still owe a large balance when you file your tax return. It's called the safe harbor rule, and once you understand it, tax planning becomes a lot more strategic. So what is the safe harbor rule? The IRS expects taxpayers to pay enough tax through the year, not just in April. That is actually Section 6654 of the Internal Revenue Code, that it will impose a penalty when you don't pay enough estimated taxes, because the United States system is a pay-as-you-go system, which means that as we make the money, we are supposed to be paying the taxes. But there are legal ways to avoid that penalty. In general, there are two main ways to satisfy safe harbor. Pay at least 90% of your current year total tax liability, or pay enough based on your prior year tax liability. That second option is where many taxpayers find planning opportunities. One of the most common safe harbor methods is based on your prior year total tax liability. If your adjusted gross income was $150,000 or less in the prior year, you generally avoid the underpayment penalty if you pay at least 100% of your prior year total tax liability during the current year. That means that if last year your tax liability was $20,000 and you pay at least $20,000 in estimated taxes or have $20,000 in withholding taxes, you're going to be fine, even if by the time you file your return, you owe $40,000. Even if you owe more money, you're still going to be fine because you have covered your prior year tax liability in full, which is called safe harbor, because it means you're going to be safe and you're going to save that hideous penalty from Section 6654. Then, if your adjusted gross income was more than $150,000, that threshold generally increases to 110% of your prior year tax liability. That extra 10% matters because if you miss it, the underpayment penalty will apply. This is especially powerful in three situations. First, when your income is unpredictable. If you're a business owner, investor, or freelancer, and you don't really know exactly what this year's income will be, using the last year's tax liability can give you certainty. Second, when you expect to owe much more this year, maybe you sold the property, you had more stronger year in business, or received a large bonus, the safe harbor rule may help you avoid underpayment penalties even if your actual tax bill ends up being much higher. And third, when you want to manage cash flow more intentionally. Instead of sending the IRS more than necessary during the year, you may be able to meet the safe harbor threshold and keep the rest of your cash working inside your business, investment, or reserves. So let's say your total federal tax bill last year was $100,000. This year, you expect your actual tax bill to be $150,000. If you qualify for the 110% prior year safe harbor and you pay $110,000 during the year on time, you may avoid the underpayment penalty even though you will still owe the remaining $40,000 when you file. That doesn't mean the tax disappears. It means you satisfy the IRS threshold for avoiding that hideous Section 6654 underpayment penalty. And for many taxpayers, that creates a major planning advantage. Safe harbor helps with the underpayment penalty. It does not eliminate the tax by itself. If you still owe when you file, interest may still apply, and in some cases, failure to pay penalties may apply if the balance is not handled properly. Timing also matters. Estimated tax payments are generally due on specific dates during the year, which are the quarterly payments. So if you miss those deadlines, the calculation becomes more complicated. And one more important point, the prior year method is not the only safe harbor method. In some situations, paying enough based on the current year may be the better approach. The right strategy depends on your prior year return, your projected income, and your cash flow goals. If you've been guessing your quarterly payments every year, you may be doing more work than necessary and still exposing yourself to risk. At Global Group, we calculate your safe harbor amount, build the payment strategy, and help you manage taxes with more precision and less guesswork. Call us or schedule a consultation through our website. Let's make this the last year you overpay or underplan.